Hey everyone, happy Thursday, July 18th. It's about 9:45 in the morning on the West Coast, and it's time for another market updates. Going back to last week, we were in a nice little rally. CPI inflation had come lower than expected, and mortgage rates dropped about a quarter of a point or so. But the last couple of years, every time we've had a nice little rally, seems like we've given it back the week after. So let's see how that went this week and see if we could hang on to those gains. Real quick, the first thing we got going back to last Friday was the June PPI, which is the producer price inflation number. So not the consumer side, us spending money, but the people producing these goods that we buy. And that came in hotter than expected, and there was some upward revisions to May's numbers. So not a good report overall for us. Like I said, the estimate was supposed to be 0.1 on the headline up. The core was supposed to go up 0.2%. Both those doubled to 0.2 and 0.4 respectively. And like I said, they made some revisions to May. So May went from a revised upward from a 0.-2 number to 0, and then from 0 to 0.3. So overall, not a great number for us. It's a little, so we'll have to see how this plays out. Because again, a lot of times, cost for producers ends up getting passed on to us. The savings don't always get passed on to us, but the costs definitely seem to. So not the best one, but the markets, shook this off. So that was good to see. Next thing we got was June retail sales. They came in line with estimates, just flat month over month. But May was revised a little bit higher. And the other thing that was a little interesting about this one is that there was a ton of seasonal adjustments. Without the seasonal adjustments, this number actually would have came in at negative 5.6%. Which would have been like the lowest in 33 years or something like that. So we know they don't do the best job of seasonal adjustments. And with, the craziness of the last few years going back to the pandemic, some of their seasonal adjustment models might be off. So it'll be interesting to see, if these get revised at a later date. But overall, again, it was one of those ones that on face value came in a little bit negative, but then you dig in a little bit and it seems like not as strong as it came across. And a lot of the spending looks like it's on the upper tier. So middle class and people on the lower end of the financial spectrum, aren't spending much money at all. And a lot of the money is being spent at the higher end. Next thing we got was June housing starts and permits, and there was a big jump in multifamily. So let's take a closer look at this. Keep in mind, permits, that's our first sign of future inventory. And single families down across the board. You see single family permits, starts, and completions. Completions up a little bit, but starts and permits down. But these big jumps in multifamily, so apartments and things like that. Permits up 16%, starts up 20%, and completions up 26%. So that's all good for future inflation, rent inflation. So the more apartments available, the less, all the landlords can charge for rent. So that's good for that component. But we would definitely like to see more single family built for, our industry where people are trying to buy homes. And another thing to keep in mind, household formations is at an annual rate of about 2 million right now. So that's our demand. That's how many people are looking to either get an apartment or buy a home each year right now. And permits, we're at about 1.45 annual pace. So we're still operating at about a 500,000 plus deficit. So that's not boding well for future housing inventory of having more supply than we need. That's something to keep an eye on. And again, good for current homeowners, not necessarily good for people that are, hoping prices drop and we get a bunch more new inventory out there. Next thing we got today was initial jobless claims, and this came in at 243,000 new claims. Expectation was 229,000, big jump. And then continuing claims, I think it's the highest number since 2021. So those jumped as well. And like we talked about last week was a holiday week. They tend not to do a good job of adjusting for holidays. And then this number, then now we got the full weeks this week, and this jumped quite a bit. Also positive for us, this week's claims would be the sample week that they use for the BLS jobs report coming up next month. So the fact that this one's higher, is a good indication for next month's jobs report that maybe we'll get a more favorable number. Next thing we got. So, overall, the Fed has been a little more dovish. We've had a lot of Fed speakers this week across the board. And, really it's sounding a lot like September is kind of being firmed into, being a price cut or a rate cut that month. Some seem to be on board doing it earlier, but overall it seems like, a better sounding tone to what they're saying, which we like to see. And then one thing I want to touch on real quick, Fannie Mae released a study about down payments and what borrowers and people shopping think they need. And I believe it's only 10% of people that are looking for a home think that or know that they can get a mortgage with a down payment of 5% or less. And I think only 14% of active people shopping believe that. And obviously that's true. You can get a mortgage, you can, 5% on conventional. Some programs will go down to 3% on conventional. Obviously FHA, you can do 3.5%. USDA and VA, you can do 0. So it's alarming to see that so many people out there have the misconception about that not knowing exactly, what the down payment requirements are on a loan. So that's that's on my industry, that's on realtors to make sure people know that, hey, you don't have to wait till you have 15-20%, which is the median, and most people think you have to have 15 to 20%. You can do it a lot less than that. So that was something I found interesting and jumped out to me this week. And then where are we at? So the average 30-year conventional is at 6.83. Last week is at 6.85. So pretty flat. That was good to see. I was just happy we didn't give back the gains, like I said earlier, like we've tended to over the last year or so. So nice to see we held on and even gained a little bit. And coming up next week, we got the PCE. Next Friday, we're going to have PCE. That's the big form of inflation. That's the Fed's favorite form. CPI came in our favor. If this PCE number comes in good, that will be great to see. And then the Fed's meeting is on July 31st. Right now, I think the market's it's like about a 5% chance that they would cut then, 95% chance they're not going to do anything. But then when you get in September, it flips. It's about a 95% chance that they'll either do 1 or 2 cuts, and only about a 5% chance that they'll do nothing. So good to see. It looks like the markets are definitely pricing in that Fed rate cut coming in September. Ideally, it would happen sooner, but we would take some pretty miraculous data over the next week or two for the Fed to change their mind. So good to see, though, to see that they're going to make those cuts eventually coming up in the fall. If anybody needs anything at all, please don't hesitate to reach out. Other than that, have a great week, everybody. Thanks a lot.